What is fundamental analysis? Fundamental analysis is the process of predicting the Forex market by analyzing economic, social, and political forces that may affect currency prices. To be able to use fundamental analysis, it is essential to understand how economic, financial, and political news will impact currency exchange rates. This requires a good understanding of macroeconomics and geopolitics. No need to be intimidated by such fancy-sounding words, though. For now, just know that fundamental analysis is a way of analyzing the potential moves of a currency through the strength or weakness of that country's economic outlook. Pros of fundamental analysis. Fundamental analysis helps traders and investors to gather the right information to make rational decisions about what position to take. By basing these decisions on financial data, there is limited room for personal biases. Rather than establishing entry and exit points, fundamental analysis seeks to understand the value of an asset so that traders can take a much longer-term view of the market. Once the trader has determined a numerical value for the asset, they can compare it to the current market price to assess whether the asset is over or undervalued. The aim is to then profit from the market correction. Cons of fundamental analysis. Fundamental analysis can be time-consuming. It requires multiple areas of analysis, which can make the process extremely complicated. As fundamental analysis takes a much longer-term view of the market, the results of the findings are not suitable for quick decisions. Traders looking to create a methodology for entering and exiting trades in the short term might be better suited to technical analysis. It is also important to consider the best and worst case scenario. While fundamental analysis provides a more well-rounded view of the market, it is possible for negative economic, political, or legislative changes to surprise markets. Economic calendar. Traders use an economic calendar to monitor events that have a high probability of impacting the financial markets. Examples of events that are listed on an economic calendar include interest rate decisions, payroll numbers, changes in the gross domestic product, the Consumer Price Index, and hundreds of other types of events. How to read the economic calendar? Visit myfxbook.com and click on Economic Calendar. Here you can see that the events on the calendar are graded none, low, medium, and high, depending on their likely degree of market impact. The fourth, which is high, means the event is expected to have a significant impact, while the effect of the other three will depend on other factors. The forecast is the median forecast of 20 to 240 economists surveyed by big agencies like Bloomberg. The actual reading is the reading published by the official source. For most indicators, if the actual reading is higher than the forecast one, it's positive for the currency in question. Unemployment indications are the exception. For them, the lower the reading, the better for the currency.